Good evening, everyone. My name is Yogesh. Thank you so much for joining this webinar. Century Financial has been doing a series of webinars from a very long time, and this part of the webinar today will discuss about a different type of important points. Basically, what we can collectively summarize as 6 keys to effective investing. Uh, Investment as an word is something which you hear a lot, but the very purpose of the investment, when we talk about, we need to understand uh, what's the purpose of investing. Is it just because you are earning this amount and you want to save it somewhere? Is that the purpose of investment? It's not. When you see the purpose of investment, it has to be a certain amount of growth. And why do you need to grow your money? Because if you keep it idle in your bank or next to your bed or bury it under the ground, it's not going to grow. It's going to rot. Even when you keep your money in the bank where you do not earn any interest or anything, just save your cash, its value get eroded. So if you see in a present scenario, 100 dirhams, what it is today, it may not be the same after a few years. Or the value of 100 dirhams, the things which you could buy in 100 dirhams few years ago, you cannot buy it anymore. That's what inflation does to you. And the whole idea of investing into the right areas is to somehow beat inflation, or at least negate the effects of inflation which happens on your money. So today in the session, we'll understand what are the keys to effective investment. We'll try to understand also what are the things which we should do if you're buying stocks, if you're investing into commodities, how do you diversify? So we'll have also a live platform working in where if you're interested, we can always understand that how to do live trades in the financial markets, and how to understand the historic pricing as well. So this is something which we are going to cover. It's a really broad uh, webinar in terms of the topics and the things which we cover. Now, before I start, I see a lot of attendees from different areas, and I would like to understand what are the questions which you have in your mind. You're attending this webinar. I'm sure you have something in your mind, whether it is related to current market scenario or anything. Please write down on the chat so I can understand that what are your questions, because I used to conduct a lot of seminars and it used to be very interactive before the pandemic happened. And now we are restricted to conduct only webinars, but I want to make sure that it's more interactive. So please write down your questions, send me. Also send me a big yes if you can hear me, if you can see me properly, if you can see the presentation properly. In case if there is an issue, you cannot attend it right now, you have to go somewhere, then don't worry about this. This will be uploaded on YouTube as well once we finish the session. So by the time, please write your questions. I would like to see what kind of expectations do you have from this session. Is there something you would like to know about stocks, about commodities? Otherwise, we'll anyways progress in our way. And as a ritual before we start, I will just conduct one poll. How many of you have invested in global shares or just shares? Invested in shares. So I'm just sharing a poll with you. Have you invested into shares? And this could be in your home country, it could be here, it could be global stock markets. Please tick if you have and check if you not. And the idea is very simple. We'd just like to know that those who have not invested in shares perhaps can just write a uh, quick text that what are you investing into. Okay, mutual funds. Mutual funds count equally. If you have invested into mutual funds, mutual fund comprises of shares. It does comprises of precious metals and commodities also in some. Okay, somebody asked me a question: how to take the first step, how to choose stocks, short term or long term. Very good question, very good question, and most asked question. Will go through, definitely will go through this. Although this is a question which cannot be answered in 5 or 10 minutes. There can be different sessions to it, but I will try my best to answer this. And yes, for those who have invested into mutual funds, it does include stocks as well. Sometimes it includes commodities as well. Perfect. So my poll says 75% of you have not invested into shares, while 25% have invested into shares. That's good. I'm sure the remaining 75% must be either trading into shares, investing into commodities, mutual funds, different asset classes, real estate. And I hope things are working out for you. But what we'll do now is begin and understand the role of investments, and we'll also understand that what are the things we should do and not do. Needless to say, I'll take you also to the live platform to answer some of your questions about the investments bit. And please keep writing questions. Somebody just asked me, short-term investing will give same profit of long terms. Uh, I would refrain from using the word profit in all my sessions because this is something which is, if profit comes by, nobody minds, everybody takes it. The important thing to talk about is how to manage your risk and how to ensure that the steps you have taken to cut down or minimize your risk is enough. You focus on that, maybe you will end up making a profit. But first point is minimize your risk, and we'll go through how to minimize the risk as well. So starting with, uh, please understand this. Whatever strategies or points I will be telling you, by no means it is any kind of suggestion or recommendation to you. We are not suggesting you anything. I'm not recommending you anything. I will show you a couple of strategies. If it works out for you, we'll share a very general view about how things work. But please understand your risk and only then invest into financial markets. These days, the fluctuations, the volatility in the market is all-time high. It's going really fast. Gold has moved $200 up and down over a period of hardly a month. We have seen yesterday US stocks falling down, and today again there's a slight recovery which has happened. So volatility is really high. So please make sure that whatever money you invest, you do not end up taking a very high risk or a very high leverage. So moving further, when we talk about effective keys to investing, we have to understand that it's not only profits which somebody aims for. Gain in the investment everybody likes to do, but then you have to minimize your losses also. There is obviously no guarantee to any investment strategy, but then what happens is, if you follow certain ground rules, there are ways that you can make your investment much better, rather if you go haywire. Now, before I launch onto the effective keys to investing, let me tell you a few things which you can do these days while the markets are running crazy. And this is a very commonly asked question during a crisis. Uh, and I will speak more on what is happening right now during this crisis. For us, crisis is this pandemic, and the pandemic has shown us all colors of uh, the cases rose, the cases came down, rising again, possibility of a second wave. We saw oil prices getting negative. We saw gold reaching all-time high. We saw stock markets going all-time low. We saw stocks market going all-time high. So there's all colors of volatility and risk you could expect to see. It's like a dramatic movie which has been going on from last 3 4 months. Now, a common investor question is, what are the strategies we should do during such kind of crisis? And trust me, the things which I'm sharing it with you, it's not that you may not have heard this before, or you have not done this before, or you have not thought of doing this before. These are very common things, but very difficult to execute it, because as human being, urge to make more money, urge to find a shortcut to make more money, greed, everything takes over. And that's why these kind of things are very difficult to follow. Now, starting with the first point, low investment risk only. So during a crisis, a lot of things happen. Unfortunately, there have been so many people who lost their jobs, people who have difficulty in finding their jobs. At the same time, there are people who were earning a specific amount of salary and there were deductions 30%, 40%, 50%, 70%. So you have to understand one thing, that during crisis, you need to invest in low risk products. Now, when I say low risk products, and you will be thinking, oh, it's so easy, low risk products. So all I have to do is invest in low risk products. But understand what happens during the crisis. And this is the best example. We have received so many phone calls and so many queries about trading into commodities and currencies, specifically in March, April, and May. Why? Because when you run out of job, when your salary gets reduced, when you are working from home, you get this bit of time, and sometimes you feel that I need to make more money. I need to level up with the money which I've lost. So you will start investing into high risk products. You will think, let me buy gold today, 100 ounces. Tomorrow it will go up by $20. I'll make $2,000. We hear it so often, and all of you, if you can control this, nothing like it. But I've conducted a lot of seminars, and every time I talk to people and they say, let's buy oil 1,000 barrels. It goes up by $2. I'm going to make $2,000 profit. That's not how you deal with crisis. When there's crisis, that means the money which you have is very valuable and it's very short. You need to invest into low risk. Now, when I say low risk, it doesn't mean just invest in bonds because you get your capital protected. I mean, that is one thing, that you can buy bonds and keep it. You will get a fixed percentage of return, and then at the end of a year, if the bonds do not default, you get your capital back. Obviously, it's less riskier than any kind of stocks we are talking about, because shares and stocks, these are companies, and obviously during crisis we see shares coming down. So that is, we have seen this happening, right? But also, what we have to understand is, when we are talking about low investment risk, we should make sure, and we should always remember, that low investment risk can be, even if you're looking at stocks, there can be some shares which are less riskier as compared to another. It can be, when we talk about companies like ExxonMobil, or when we talk about companies like Walmart, like anything which is less riskier during the crisis, or not Walmart. Actually, I should talk more about Unilever, for example. Imagine during crisis, one thing which you will never stop: buying a toothbrush, or buying a toothpaste, or buying daily of your products, which normally we call them consumer staples. Now, consumer staples, the sector itself, which you will see, uh, when we talk about consumer staples, first is low investment risk only, which means most of your exposure should be in bonds, because you get a fixed income on your bonds every six months, depending on how the bond is. And then at the end of a certain maturity, you get your capital back. So during crisis, that could be one thing. Now, again, some of you will argue on the fact that bond yields will be low, so the coupon will be extremely low. That is true. And that's why I told you that a part of your investment portfolio, majority should be into bonds or fixed income products. And another part, if you're investing into stocks, try to invest into stocks which are consumer staples. Now, consumer staples, something like supermarkets, right? Something like which sells the products without which you cannot uh, you know go ahead with your daily lifestyle. Walmart, in all the ways, is one kind of a consumer staple company. There are, Coca-Cola is a consumer staple company. Procter and Gamble is a consumer staple company. right? So if you talk about even Target is a big US stocks, and Target in itself, it's if you see for the month of September, you will see companies like Tyson Food, companies like Kroger Company, companies like Campbell Soup. Now, Campbell Soup, these are manufacturers and they make food and beverage based products, pasta sauces, Mexican sauces, potato chips, juices, etc. And you will be surprised to know that last quarter, around June, during the pandemic, the sales boosted by 17% because people bought more soups, snacks, sitting at home. And if you see their full forecast for the next year, the prices, they are expecting a very high increase in their revenue. Kroger, for example, Kroger in itself is a supermarket, and there are drugstores, there are jewelry stores, there are convenience stores of this particular thing. And they're also engaged into processing of some of the food they sell it into the supermarket. So what I'm trying to tell you is the very first thing is you start investing to low investment risk products. And second is invest into consumer staples during crisis. Don't invest into the Apples and Facebooks, and because what happens is during crisis or during recession, when we see the companies which are much more non-cyclical in nature. When I say non-cyclical, that means, as I said, Campbell Soup, Walmart, the Kroger company, the convenience stores, they continue to provide numbers. They continue to provide the sales, right? And in fact, some company which is making more juices during this pandemic, those companies have shown a decent amount of profit. So you need to be smart. You need to pick the right business for the right situation, right? Then goes, as I said, investing in consumer staples, recession resistant industries. So the ones which we talked about, the consumer staples, these are the ones which are recession resistant also. Because recession resistant is a very strong word, but just consider it this way, that when we say recession resistant industries, we are talking about all different kinds of companies which are whenever there is volatility or whatever the situation is, like grocery stores, discount retailers. And again, it is a lot depends on what kind of investing you're involved into, but beverage manufacturing companies, cosmetics again, normally there is a difference. Very expensive luxury stocks will not be a good idea, but then something very basic, for example, Estee Lauder companies like Coty Inc. and Estee Lauder, these are kind of major licensed brand manufacturers, and they have not only cyclical products, they have some non-cyclical products also. So even during the weak economic conditions, apart from the luxury brands, these kind of brands can be really helpful if you're in, because cosmetics also come into luxury and not luxury, something which is very basic. So those cosmetics are sold by Estee Lauder and Coty Inc. So these kind of things, it's something which you can. So again, as I said, when you are talking about recession resistant, you should look into companies like consumer staple grocery stores, and as I said, beverage companies, cosmetic companies, which are very basic ones, which are non-cyclical in nature. Something like Ulta Beauty is much more expensive, much more luxury. It's Kim Kardashian's brand, so it's much more expensive. So that's not something which you should go for. But then very basic cosmetics, inspired recession or no recession, the basic cosmetics everybody buy. So you can try to look for those things. So similarly, ensuring sufficient diversification. Now, this will be something which is one of the important keys also of investment. You will understand ensuring sufficient diversification. Diversification in itself, I always ask this question. I want to make sure that everybody's on the same page. Please type, what do you think diversification means? You can see a small pie chart over it. What do you think diversification is? Please feel free to write it over the chat. What do you think diversification is? You don't have to give me a full sentence, 2 words, 3 words, whatever you feel like. I just want to ensure maximum engagement because it's just me talking. So I don't want to bore you. Please tell me, what do you think about diversification? What does it mean? Okay, I'm getting answer one, two. Okay, okay, okay. Yeah, I think most of you know already what how diversification works. Yeah. So different allocations, and various different sectors, of course. So different sectors, you invest into different sectors, but do I only invest into different sectors? Do I only invest into different industries? So if one thing is good, you invest into different sectors. For example, these days, if you're only investing into uh, technology, people are everybody's talking about one sector, and that is tech stocks. Tech stocks, Apple, Netflix, Facebook, Disney, Google, everybody's talking about this. What happens if you solely invest into all the tech industry? Tomorrow, if tech comes down, yes, somebody said divide your assets in low risk and high risk, of course. So even that way you can diversify a set of low risk products, a set of high risk products, and within the sectors also. So if you invest into tech industries, please also invest into consumer staples, invest into companies which are non-cyclical in nature, invest into companies related to telecom or energy or material or industrial, pharmaceutical, biotechnology. So just that you're not exposed to the IT sector all in one. So that's called ensuring sufficient. But are we sufficiently diversified yet? We did invest into different sectors, but what about the different economies? If you're only investing into US stocks, you are exposed to US elections, which is going to be in November 2020. Anything happens, if your all investments are in US market, then you are just relying on what happens in US elections. And past historical data tells me that people in US do not really have an understanding of whom to vote and whom to make president. So do not be exposed to one economy for this much. US, Europe, UK, Japan, China, India, emerging markets, your investment should be much more. So your stock markets could be different countries, then different sectors, what we saw, different industries. Also, this is just stocks. To ensure sufficient diversification, you move on. So one part of diversification is that you put money into stocks like, okay, tech is one, then industrials is another, consumer staples is. Also diversify between growth stocks and dividend stocks. Does anyone know how much dividend Amazon gives? Amazon is such a big company. Take a wild guess. How much dividend does Amazon gives? Please write your answers on the chat, whatever you feel. If you know, if you don't know, tell me how much dividend do you think Amazon gives? Okay, I got one answer. I'm waiting for more. Please go ahead, guess a number. You, if you're online, you have enough chance to go and search. Okay, somebody said 20%. More answers, guys. More answers. Okay, no idea. That's also good. It's right in some way. Okay, okay. So the correct answer is Amazon does not pay any dividends. They just don't pay any dividends. So what they thrive on is, it's very simple. Amazon, if you see, they have never paid dividends. They just thrive on very simple thing. Whatever profits they get, they reinvest into their business, and they try to gain more and more market share. When Amazon had to come in Dubai, all they had to do was buy souk, right? Now Amazon, if they want to go to Africa, all they have to do is buy Jumia technology, which is called the Amazon of Africa, right? So for Amazon, they have not paid a single dividend. But tell me one thing, how much do you think Amazon has grown in last 1 year? Can you tell me the growth of Amazon in last 1 year? Take a wild guess. In last 1 year, how much Amazon has grown as a company in terms of the stock price of Amazon? I'm asking you all these questions to just keep you engaged so you do not leave the screen and move away. Tell me, how much do you, okay, 100%. Somebody said 100%. Okay, 150%. Okay, 200%. Okay, 20%, 50%. Okay, okay, okay. So Amazon, to be precise, has gone up around 70%. So yeah, I mean, it won't be wrong to say it has gone up by 100%. It has gone up by 70, 72%, given the fact that stock has come down in last few days. So yeah, give or take, let's make 100%. Imagine company does not give no dividend, but the stock has gone up by 100%. So do you need a dividend? Basically, you don't need a dividend. In 1 year, if your investments go up by 100%, why do you need a dividend? But also, Amazon fluctuates a lot. It's a growth stock, which means it constantly thrives on updating new technology, and it is much more vulnerable. So if you invest in Amazon, right now the current price of Amazon stock is $3,500. And if you buy 10 shares of Amazon, Amazon is capable of going down by $500 at any point of time. That's loss of $5,000 for your $10,000 account if you are invested. So what you have to understand is the tech stocks do not give dividends, because whatever profits they get, they put it back into research and development. Which kind of companies give you dividends? Coca-Cola, Vodafone, Johnson and Johnson, ExxonMobil, Chevron, Total, ENI, Royal Dutch Shell, British Petroleum. These kind of companies, they give you dividends. So your diversification quota is not full until you have done a proper segmentation between the stocks, which will not move that much. The volatility in Exxon and the volatility in Total or other stocks will be very less. It will move probably this much throughout the year, but their dividends, they will give you fixed dividend year on quarter on quarter. On the other hand, stocks like Amazon, stocks like Apple, they will not give you any dividends, but they will have major movements. How much dividend do you think Tesla gives? Nothing. And tell me how much Tesla has moved. Anyone who has an idea how much Tesla has moved in last 1 year? Take a wild guess. How much do you think Tesla has gone up in last 1 year? Everybody has a Tesla story. I'm really not sure who had ever invested in Tesla, who had that kind of faith. But tell me, how much do you think Tesla has gone up in the last 1 year? Okay, 80%. Okay. Anybody else? Please give me answer. This is just to keep you more engaged. You will love this. More you, while you're online, you can. Okay, somebody said over $1,000. Okay, it has gone over $1,000. But how much do you think in percentage terms it will be? What was the price a year ago? Okay, somebody said 50%. Okay, you'll be very happy to know in percentage terms, Tesla has gone up in 1 year by 612%. 612%, which means had you invested in Tesla 1 year ago, the price, you would have seen your investments growing up by 600%. And that is when it is trading less than its all-time high. Markets have, do not forget, markets have come down in the last 4 days, right? So it has gone up by 600%. How much dividend they give? Nothing, zero. Do you really need dividend? You don't. If your investment grows up by 600%, why do you need dividend for anything? But again, if it goes up by that much, there's a possibility it might come down by 50%, because that's the volatility tech stocks face. That's why you should never be exposed too much over your tech. I meet a lot of clients, and sometimes they have investments in banks, hedge funds, everywhere. And because tech is this booming industry, so their most of their assets are invested heavily into tech. You should not do that. Please diversify into dividend stocks and tech stocks. Dividend stocks can be your Coca-Cola, can be your different kinds of companies, Pfizer, Johnson and Johnson, a lot of companies which are providing dividends, and you can be a part of that, buy and keep it, right? And receive a fixed income dividend on it as long as the company is in profit. And then after you have diversified among the stocks, now you diversify within different asset classes. Precious metals during crisis has always been one of the most talked thing about, whether it is recession, crisis, trade war, Brexit, pandemics, war situation between Russia and Ukraine, or Saudi and Russia, oil price war. Everything has collectively led to make people buy, to make people think that gold, investment in precious metals and gold, is the way to deal with the crisis. Gold, ladies and gentlemen, has earned a specific status of safe haven. What is a safe haven? A safe haven is an asset class, or when I say a asset class is a safe haven asset class, when it provides you uh, a kind of threshold. So a safe haven asset class will retain its value while the stock markets are going down. Okay, that's why we call them safe haven. So gold has earned this status from month on month. We have seen from the time when the oil price war started, to the pandemic, to the trade war, to what has happened, there has been a spike in gold prices. So precious metal can also be one of a neat investments when it comes to during crisis. Again, as I said, risks lie everywhere. So you have to understand. Please do not take a loan. Do not borrow money from anyone. If this is your child's education money, then make sure that you are invested more into low risk products rather than in taking more exposure in commodities like gold and oil. Do not trade into currencies day on day basis if you have an absolutely low risk appetite. Okay, this is something which you really need to take seriously. I'm sure you must be thinking, and these are such a basic common sense points, but trust me, the best of the investors do the worst of the mistakes. So please be careful. Now, moving on, while what we covered that during crisis, what kind of investment strategies we can look into, what kind of stocks we can look into. We talked about consumer staple stocks. We talked about recession-resistant industries. We talked about how you can diversify between growth and dividend stocks. We talked about how you can invest into precious metals as well. Now, moving on, the effective ways of investing. First thing which you need to understand is you have to grow the nest. What you see is, my friends, the snowball effect over a year, 1 year, 5 years, 10 years, 20 years. So the magic of compound interest always continues to amaze us. Now, what we need to understand is the rolling snowball effect, as you see. And if I put it simply, compounding pays you earnings on your reinvested earnings, which means longer you leave your money at work, it will work for you. And the numbers will get more and more exciting. So if you see an investment of $10,000, and let's say it grows at an annual rate of 8%, for example. And when I say 8%, it could be anything. Let's say if you bought Amazon stock 20 years ago, and obviously it has grown over a higher rate when we see average and average. But let's say if that was a $10,000 which grows at a rate of 8%, in 20 years, if you have not done any withdrawals, your $10,000 investment becomes how much? $46,000. In 25 years, it would grow 68,000, and in 30 years, it will become $100,000. And again, it's a hypothetical example, because when we talk about stocks, uh, stocks do not always remain in the same way. Uh, you need to review your portfolio on a regular basis, because money left alone in an investment, it can offer the potential of a significant return over time. But if the time is with you, if markets are on a constant high, then you buy and keep it. Just do a periodic review. There could be a very well chance that things might work out. For those investors who would like to understand this thing, I will share my live platform with you once we finish this presentation. From 2016 to 2020, S&P 500 has just gone up. US 30 has just gone up. Stock markets, most of the US stock markets have just gone up. So had you bought that time and hold on to that money, even your dividend stocks, if I tell you. So at a certain rate, every stock has grown year on year. In last 5 years, stocks like uh, Netflix, for example, in last 5 years would have gone more than 250%, right? So on an average, if you see 60% growth, Netflix year on year could have given. So if you just buy and hold on to it, the wonders which compounding can do, that is something which you need to understand. Please remember this. I'm talking about buy and hold, but I'm not talking about buy and forget. People buy, they don't check their portfolios, leave for 20 years and 13 years and 10 years and God knows checking wonders. That's not how investments work. You just don't buy and leave it. You have to do periodical reviews. You have to see if the profit is enough. If something which is enough, let's say in next 5 years you have made something and then you're expecting a decline, then please do not shy away to book your profits also. Investment is much more dynamic. It cannot be fixed. At least these days it cannot be fixed. Don't follow what Warren Buffett did 20 years ago, because that thing doesn't work no more. If you think I'm going to buy this and keep it for the next 20 years, you don't know what is for the next 20 years. Do you really think that you can predict what the next 20 years will be like for any company? When the pandemic hit, the best of the companies went bankrupt. And these were the companies which we could see. Just see what happened with General Electric. GE, for 109 years, it was a part of the esteemed US stock market index Dow Jones. And General Electric is not the part anymore. It has faced so much of losses. So don't think, and imagine what happened with Jet Airways in India. So you have to do a periodic review. You have to understand that how much return if I generated in this year. Is this normal to the common benchmark or is it more? If it is more and if you're outperforming, then yes, book your profits and wait for another opportunity. But you have to grow your nest slowly. You have to have long-term investments also. And when I say long-term, it doesn't mean 20 years. What you see a snowball effect is that's how it works. But when I say your long-term investment, at least consider next 1 to 2 to 3 years and see how investment works. Because in global markets, you see a lot of movement in the 2 to 3 years, right? So that's the first thing. Second, no pain, no gain. It is as simple as that. A lot of investors will come to me that tell us something which is traded the most and has the highest of the income and the lowest of the risk. There's no such thing. Something which is traded so much will always have volatility. Something which have too much volatility will always be more vulnerable to the risk. It will be high reward, but it will be high risk. So you have to make your mind with that. And you have to endure short-term pain also for a long-term gain. Now, what happens is, this is a very important point. Please note this down because we are living this example right now. If you had invested $10,000 in stocks and the price of stocks dropped like a stone, which we saw during the pandemic, and I'll share the graphs with you on the live platform, stocks just crashed on the day around February and March when we saw stocks coming down. And on paper, if you have that trade, you have lost a bundle. And obviously there is no compounding because you just saw your stocks crashing. So that particular year is kind of not going well for you. There's no denying it. And volatility is the part of financial market. So you have to also live with it. But please remember two things always. Longer you stay with a diversified portfolio of investments, more likely you are to reduce your risk and improve your opportunities for gain. Longer you stay with a diversified portfolio of investments, more likely you are to reduce your risk and improve your opportunities. So when you see the past performance, the past historical prices have said this, but it does not guarantee you the future results. Long-term direction of the stock market historically has always been up. You pick any stock market, apart from Venezuela or Turkey or any one of those controversial areas. You pick any, you pick Indian markets, you pick UK markets, US market. Historically, when you will see the stock market trend has on a longer term has always been up. And when you will see, if you had attended one of my sessions where we were talking about volatility, recovery, and everything, you will see that I shared a graph with you where it showed that the decline in the stock is for a smaller period of time, let's say 20% decline. But after that, when the recovery happens for the next 10 years, you will see the growth is very significant, right? After every recession, you will see the next 10 years growth is phenomenal. So for a longer period of time, yes, stock market has historically been up. So you take your time, understand how much time you want to put your money in. Whenever you're investing, please understand the time horizon, because if you get panic and take your money out because you needed that money in 3 months and market crashed and now you have less money and you don't want to lose more of it, so that is something which you really need to decide before you invest, right? For assets you will use soon, you may not have the time to wait out the market, and you will think that, okay, you know what, this doesn't work. But long term goals, you have to decide your long term goals. Second thing, what I was talking about is that during any given period of market, or whenever there is any kind of economic turmoil which happens, some asset categories or some individual investments historically have been less volatile than others. Like, for example, bonds have normally been less dramatic than stocks. Uh, just by diversifying, it doesn't mean that you're always going to make profit, but the possibility of loss and the possibility of minimizing your risk is somewhat kind of gets managed, right? So this is something which you should always remember, that you have to endure short-term pain to get a long-term gain. If this is the time you feel that oh, markets have come down, like happened in last 4 days, a lot of people were buy on Tesla and Microsoft, and stock came down easily 10%, and some of them got panicked because they over leveraged, they took their money out. Today the stock has gone up, Tesla has gone up, Microsoft has gone up. You have to give time. That's not how it works. So you cannot just expect that, oh, today I bought, in the next 10 days all stocks came down. That's why you have to understand. So we'll read about one more effective way which will tell you how to invest long term properly. We already discussed about diversification, that how you can diversify into stocks, you can diversify into bonds, commodities, etc. Next, time horizon. We understood about time horizon, that if you are you have to understand that whatever money you have invested, what's the time horizon of this. uh, Investment choices should, so for example, if you need to use your money quickly, that is tied up in an investment whose price is currently down, what are you going to do, right? If you bought a real estate with that money and you need money after 6 months, can you sell real estate after 6 months? Maybe. I mean, you might be, but tell me how easy it is to buy it now and sell it after, say, 3 months, a piece of land. Property prices change, and it's not easy to find a buyer. It's an illiquid market. So you have to understand, please consider your time horizon when you are investing. Because if you need your money back in 3 months, you cannot invest into real estate. You cannot expect in 3 months wonders will happen. So that is something which is really important. You should always take care of this, because if you will need the money within the next, say, 1 to 3 years, you may want to consider keeping it in as a cash alternative or somewhere where you can easily get it, right? Your rate of return may be lower, but then the volatility of the instruments, that is something you can sleep easy. So please understand, the time horizon is something which is really important. And next comes dollar cost averaging. So when you're talking about long-term investment, let's say for the next 5 years or something, dollar cost averaging, the word in itself tells you to average your trades, what you buy. And when I say trades, that means I'm specifically talking about stocks. I'm not talking about currencies, gold or oil. Please do not average or buy long-term currencies. That's one of the most dangerous market. When it comes to stocks, there are always good companies which, when come down, present you good buying opportunities. So what you should do, dollar cost averaging means that if you want to invest $100,000 into, say, Walmart, and you see Walmart prices are high right now, for example, but you don't know whether it's high because it's all-time high, so it can go up further. It may not come down, so you don't want to lose this opportunity, but you have $100,000. What do? You average, use the dollar cost averaging method, divide that amount by 3, 33,000, invest now in Walmart. Wait for the market correction to come. When it comes down by, say, 5-10%, put another 33,000. Let it come down by another 10%, then put another 33,000. What will happen? Your 100,000 gets invested into 3 different layers at 3 different prices. So the middle one becomes your average price, which is certainly lower than the top one, right? This is called dollar cost averaging. Again, something which is talked a lot, but what happens now? What is the flaw in this? Not in dollar cost averaging. What is the flaw in investor psychology? You will see Tesla going up. You will feel like, no, this is a highly uptrend. How can I be away from it? Let's buy as much as I can and let it go up. I'll make more money. What happens? You put all your money into Tesla, and when Tesla does not go up and starts coming down, you want to buy more, but you don't have more money because the money which was allocated to Tesla was used at once because you were greedy. That is, my friends, something which you should not do. So please understand this. These are very common things, but tell me, trust me, when I talk to people, it's not something what people are doing very often because it's the right way to do. Something which tastes very good is not healthy for you. Burgers, red meat, stuff, it's not healthy for you. It tastes amazing. Something which does not taste that good, like broccoli, but it's really good for your health. So with dollar cost averaging, you may not get the right adventure and excitement, but trust me, that's the right thing to do. Now, last but not the least, among the effective ways of investment, what I was talking about, don't buy and forget. This is one thing which I have seen a lot of investors, they do that. Maybe they don't have the time, and like, very humbly, I would like to ask this question: if you don't have the time to look to your investments, or to invest for that, sometimes I meet people say I don't have time to invest. If you don't have time to invest, then something is really wrong, because you're earning this money with your blood and sweat, but you do not have the time to grow that money. So please understand this. You need time. You have to find out time to review your investments. This is your money. You have earned it. Only you, in all the right ways, can feel the real pain of losing that money. So you have to spend your time reviewing it. You have to understand that this is something which is my responsibility. It's my duty. I have to. It's a code of conduct, right? So unless you plan to rely on luck, as I said, your portfolio's long-term success will depend on periodically reviewing it. Even if you buy for 3 years, 4 years, every 2 months or every 1 month, just keep looking at the prices, how it's going up. Economic conditions change. Maybe it's time for you. US elections are coming. You're already in good profit. Just book all your profits. Wait for the elections to happen, because what happens in elections, your next 4 years will be determined by that. And I'll show you right examples on the platform once I finish this. So if circumstances change over time, everything. So for example, closer to your retirement, you might decide to increase your allocation to less volatile investments. They have this rule. In my previous sessions, I have talked about this. The rule of 100 minus age. If you're 50 years old, 100 minus 50, your 50% of assets should be into, your 50% of your investment should be into riskier asset classes, but 50% should be safe. If you're 70-year-old, 100 minus 70, 30% of yours should be in relatively riskier stocks, 70% should be into proper investments, fixed income, less volatile, no adventure. So please understand that you need to review your portfolio. Just don't buy and leave it. Don't think your fund manager is looking out for you. Fund managers are not looking out for anything because it's not their money. They're managing it, but it's not their money. Money is yours. You will feel the pain of losing it. Nobody else will. So, in all the right ways, please be careful. Look, don't buy and just forget. Now, coming, these are few effective ways of investing, which I wanted to talk about. Now, coming back, some of you asked questions in the beginning. Uh, Let me just go back. And please, if any questions are coming right now in your mind, please feel free to ask. I'm on the chat session. I will read and I will try to answer your questions. Let me just go back and see. Uh, okay, somebody asked me how to take the first step, how to choose stock, short term or long term. Now we'll answer this question. Uh, let's see the next slide, which kind of tells us one thing. Since the emergence of COVID-19, US consumer confidence has declined significantly. What is consumer confidence data? It's an indicator which shows the overall health of the US economy. They survey 5,000 consumers and they take the survey, and on the basis of that, they see how confident they are, how much confident they are in more consumption, right? Now, consumer sentiment has gone down, and this is still July data. We have not considered August and September yet. September has just started, August we have not considered yet. But till July, the consumer sentiment was down by 26%. And what are the questions in the survey? How are the buying conditions? How are the business conditions? Are you getting enough personal finance or not? This is the consumer sentiment survey which happens, and it's a very renowned data of US. And that number is down by 26%, which means it's low. If there was a measurement of consumer confidence sentiment, say 100 or 50, it's not 150, it's minus 26% since January 2020. On the other hand, S&P 500, which is the global benchmark of US stocks, has shown an overall growth of minus 0.2%, right? Minus 0.2%. That means consumer sentiment is highly negative, but US stock market are still high. What does it tell you? If stock markets are going all-time high, but the consumer sentiment, consumers are scared, the buying conditions, the business conditions, the personal finance is not good. So what do we understand from this? And let me show you the chart. Look at this. So the answer to your question that how to take the first step, how to choose the stock, whether it is short term or long term. See how first you have to understand the investor shift from 1990 to 2020. From 1992, if you see, the bull market of the 90s was met with a steep rise in consumer sentiment. So the black line which you see is consumer sentiment, the white line is S&P 500. If you see a rally which came from 1992 to 2000, the consumer sentiment was also up. And when there was a recession, consumer sentiment was also down. In 2009, in 2008, another crisis happened, right? So from 2000 to 2008, we saw global financial crisis. Both indices bottomed out roughly at the same time. So if you see black line, consumer sentiment down, stocks also down. Now see 2020 when the pandemic came. Look at the consumer sentiment, the black line from 2,500 going down to 1,000. And look at S&P 500 crossing the charts, all-time high. Consumer sentiment is down, but stock markets are up. So what we are looking currently is these days, stock markets are already digesting the news of pandemics and trade wars and Brexits, and tech being one of the most favorites we have seen. In S&P 500, the maximum contribution to the rally of S&P 500 goes to tech. Facebook, Tesla's, Apple, Amazon, Netflix, etc. Right? So the consumer sentiment is down, but the stock market is up. So there's this big gap. Now I will take you further to the live platform where I will read about the general information about the news about the market and everything. But don't think that books can teach you trading. You being involved into trading teaches you trading. Books can only give you information. Experience, more you're into the market, more you're looking prices around you, you will get familiar with it. So please do that. Right, guys. Thank you so much for your attention. I'm more than happy to share these slides with you. As I said, we are doing a lot of training sessions for a lot of people, and it's free of cost. Talk to your relationship managers, take demo accounts, have one-on-one session with me on Zoom, or if you want to come here and sit, and we'll give you a lot of information, aware you about a lot of things. So that is something which we'll be doing. Before I leave, on behalf of uh, my team in Century Financial, myself, would like to thank to everyone who has people who are into medical healthcare industry, or anyone of you is in medical and healthcare industry. You guys are risking out your life for us, and that is something which is really commendable. I just wish and hope a really good health to you and your families, and make sure, um, uh, please be very safe, very careful. The cases are increasing. I was reading the other day. So wear your mask. I am right now into enclosed area, so I have my mask with me. Stay very safe, stay very healthy, and more importantly, please stay invested. Do not panic. We'll meet again next week with a different topic. I hope to see all of you again. And meanwhile, if you need to talk to me, have a one-on-one session, have a training session, please talk to your relationship managers, and we'll absolutely do something. My name is Yogesh. You have a great night ahead. Thank you so much.